We want to start with news that happened from around the world. Finance Juice does a really good job of that. The market wrap that they have, is to scroll back farther, you would see one for the Asian session. And if you would scroll back even farther than that, you'd find one for the US session. They often provide a lot of insight on what happened during the day. We want to look at the overnight session and see what did well in Asia or what didn't do well in Asia. And then what's going on in Europe right now, since it's around 12:30 London time. We do have a Fed speaker today. We've also got e-commerce. And that's about it. I mean, there's just not really a lot going on other than OPEX. And of course, that's the big shiny object that everybody is focused on. It is options expiration day. It's monthly expiration. The GEX and NEX levels have dropped off significantly. There are volatility firms out there that what they call volatility funds. And these funds, they have to buy. They don't get to choose if they want to buy. When volatility gets to a specific level, they have to. That's just what their program does. Same thing in the other direction. If volatility gets too high, they have to sell. Doesn't matter what they want to do, it's just what they have to do. Selling does not always mean that they're going to cash necessarily, just that they might go from equities to bonds or from bonds to equities back and forth. The Fed did a horrible job yesterday trying to provide some guidance. Some Fed members are really slapping the table on a 75 basis point rate hike, and others are saying, nah, maybe 50 is probably a better fit, and that's more likely what they're going to lean towards. So the market really doesn't like this indecision, and we've been seeing it in the past few days. Now, if you look at the Fed funds projection, right, this is nothing more than what the market thinks the Fed is going to do. These probabilities, we're really just shuffling back and forth between the 60-40 one way and then 40-60 the other way. These two really just keep bobbing back and forth with no clear winner yet. I look at this probably 2 or 3 times a day just to see if anything's changed, especially when I see a significant change in market structure, right? So around 10, usually around 1 o'clock, and later in the day, I take a look to see what's been changing. This is a large part of what's going on out there. The market is trying to price in, or at least position itself for what the Fed is going to do or is likely to do in September. Now, we're going to get a lot more insight when Powell is in Jackson Hole next week. So that's the next thing, the next shiny object that we're all going to be focused on. So we have retail sales. I believe that's for Canada. And then e-commerce retail sales, and that would be for the US. And we have that Fed speaker at 9 o'clock. Barkin is going to be talking. And other than the rig count at 1 o'clock, I mean, we're basically done. Now, I worked on the drilling rigs for 20 years, and this rig count, sometimes, most of the time, the change is just a few rigs. It's 4 rigs more or 4 rigs less. They stack some in the dirt, right? They pull some out of a field. It doesn't really change all that much. However, there has been a few times in the last 5 to 10 years where we have seen a significant fleet reduction and or a new fleet coming online, right? They've got these brand new state-of-the-art walking rigs and just, all kinds of really fancy stuff. So there are times where the number does change substantially. And when that happens, you can expect to see a little surprise out of the market. But most often, this number isn't going to change. And if it does, it's a minimal change, a couple rigs here and there. When it comes to energy right now, it's more about the strategic release and when that is supposed to end, which I believe is right before the midterms, and then refinery and production, right? Those sectors or industries or sub-industries have been attacked, publicly for years. Everybody wants to go green. And well, if you eliminate all of our refineries and then we get into a crunch, the refineries can't keep up. Imagine that. Plus, we're energy exporters now, right? So um, we don't have enough if we're shipping it around the world. So for today, like we do every day, there's only so many things this market can do, right? If you remember our base case argument from yesterday, it was to hold the line, that we would very likely stay inside of yesterday's price action. And that's what we did. The argument that we could hold the line today is off the table. We are already inside day breakout. We had a beautiful Busby, if anybody happened to be awake at that time of morning. I was awake, but I was working, and so I didn't see it. I think I got into the office with that little micro double bottom, and I looked at it and thought, nah, I'm not really interested in a bounce. And I didn't trade it, and it didn't bounce. So I'm glad I didn't trade it. The thing just kept on going. It really looks like I missed a great opportunity. So I hope somebody got it. That's what happens when work gets in the way. But beautiful Busby. Solid liquidation break here. Since we're already inside day breakout, we are back inside the previous week. We're underneath the daily pivot point. We're obviously underneath the VWAP. We want to focus now on, hey, where's that weekly pivot? Because that weekly pivot is a large part of, are we still bullish? The weakness that we've been seeing in the last few days does not imply that we're bearish. Not at all. Right? If we were to go out and look at the higher time frame here, we had our 786 pullback plus some, ran back up and tagged that, and now we're back above it. This auto drawn fib starts at the bottom instead of the other way around. But the 236 is going to line up really close where the 786 would line up if we drew it the right way. Right? Really, I mean, they're kind of close. So right now we're resting on it, 42, 44 half. That kind of needs to hold. Right? We can get below it and come down and tag that 236 is fine. It'll line up with structural levels around 41.78. We would still be bullish if we were to fade back down to 41.78. There's nothing at that point that would say we're bearish. Granted, we'd be down a little, but the market needs to ebb and flow, right? If it was just to move in one direction all the time, nothing would work. So a bit of a pullback to a point is just healthy. It's normal. It's fine. You can see on my weekly chart that we are inside the previous week. It's a little bit of a disappointment, right? After having, a month and a half where we didn't do anything, just holding those lows, and we finally started to expand. We had 2 weeks of expansion, and then a pause, another expansion, and now it looks like we're not even going to keep that next expansion. So 41.75 is kind of that line in the sand. I think if we get below 41.75, we really got to rethink. Is this rally strong enough to continue to go? There's a drawing tool called Regression Line, and if you start it, say on the 15th, 16th, or 17th, snap it up. The swing high and the swing low becomes pretty obvious. Now notice that the swing high and the swing low are getting more and more muted. We started pretty wide, and then it got more shallow and more shallow and more shallow. And that makes sense. When we're going down, volatility is greater. Volatility is another word for movement. Movement is greater. When we're on a candle chart, volatility really means candle close to candle close. And if volatility increases, then that means the distance between one candle's close and the next is increasing. Makes perfect sense. It even sounds right when you say it. Volatility is increasing. What's that mean? It means that the size of the candles on a day-to-day basis are getting bigger. Well, flip all that over when we start going in the other direction. We start rallying up off of the lows, and we're no longer going down, and volatility is decreasing. The size of the candles are getting smaller. The distance between the day-to-day close to close is decreasing. Volatility is decreasing. The swings on a swing high and a swing low are going to become more and more muted. So one of the things that we want to watch for is an increasing ADR or an increasing ATR or an increase in volatility. They're all three volatility indicators. They're all doing the same thing, which will imply that volatility picking up, um, the distance between each candle's close is getting greater. And we're very likely going to have bigger, wider, sweeping moves. So we're outside the box. We've got our 786 from the higher time frame, kind of needs to hold. The weekly pivot point is going to be our bullish and our bearish argument, which lines up really close with a full ADR. The full ADR is 42.23. Half the ADR is 42.55, and we're already below that. We do have a market maker move of an additional 0.5%. Well, we've got an ADR of 1.49, basically 1.5. You add in another 0.5, that's an average daily range of 2%. We're only down nearly 1%, so we could move another 1% pretty easy. It wouldn't even be considered extreme. It wouldn't be crazy or wild or dangerous or in any way outsized in its movement. So we'll just add another 1.1 here, and that'll give us our 2-point move for the day. That takes us all the way down to 4,200 flat. 41.75 is my benchmark line in the sand. If we're going to remain bullish, we really need to stay above 41.75. The move today wouldn't get us beyond 4,200. But if we did move beyond 4,200, we would just start to see what extreme would look like. But remember, we can go all the way to this distance, and it wouldn't be considered extreme yet. That would just be a decent move to the downside. Now, the argument is there that we could move to the upside. But before we have that upside argument, let's go ahead and lay out the rest of this bearish case. So suppose we stay negative through the day and the negativity increases. We would retest our own Globex low, 42.40. We've got a retracement line at 786, which puts us at 42.33. The weekly pivot lining up with the ADR, 42.25. Got a cog line at 42.11, which lines up really nice with this pivot point from the 11th. That would be close enough to the cog line that I'd probably put those two together. And then our measured low at 4,200. So plenty of pivot points, signposts, goals, targets. Each one of those would become its next stepping stone for another move lower and then another move lower. This would be a really good day to run some sort of ride the 9 strategy, or like a 10-20 cross play. And I would also be looking for any sort of midday reversal, right? Some kind of TRB setup. Not just here in the futures, but if you think about 80% of the market does what the S&P does, if we can get a TRB in the futures, then we're likely going to get a TRB in everything else, right? In 80% of the market. So we're going to be looking for, a break of that trend line, maybe a retest of the trend line, and then begin working its way back up. I don't know that we're going to get it, but a midday reversal on Friday is well, it's certainly something I would be interested in. And it would probably look a lot like this, right? We were significantly not bullish through the overnight session, got into the day, had one last hurrah to the downside, and sort of rallied back up the other direction. That'd be kind of something that I'd be thinking about, right? Where's the reversal? When's the reversal going to come? Are we actually going to get a reversal at all? So the base case argument is that we're going to stay below and outside of yesterday's range. Obviously, if we get back inside yesterday's range, it's very, very unlikely we're going to get through the other side of it and go through the top. We can. Price can do whatever it wants. And, you learn along the way to not say price can't do something, right? So it could break out of the top, but it's the least likely outcome out of everything that we could talk about today. So we do have some untouched point of controls that are probably going to be worth carrying forward if you hadn't been already doing that. We are inside the volume profile. We went through the shallow area relatively quick, as we kind of assumed that we do. Got a little bit of volume support at 42.35. If we break that, we've got another shallow area that we're likely to move through quickly, which would put us close to that 4,200. That 786 that I've got drawn there really is a critical level. It's not my level or my line in the sand for bullishness and bearishness, but I mean, that line really needs to hold. Just leave it at that. When we're at the top, we expect to go to the bottom. When we're at the bottom, we expect to go to the top. If we're broke out underneath it, we expect to come back inside. And if we're broke out above it, we expect to come back inside. So we are moving from the high towards the low. The distance between the high and the low here is more than what a typical normal day would move, because this is a 10-day, 30-minute chart. So we don't expect to make that move in a day. That is just the expectation that when we're at the high, we expect to begin moving down towards the low of this box. We're doing too. So for the untouched point of control, we have to kind of widen the chart out a little bit. Normally we would just do a 5x5, a 5-day, 5-minute chart, but these untouched point of controls are far enough away. We got to kind of turn on more days. So we've got an untouched point of control at 42.33. lines up with another pivot point that we had already been talking about. And we have another one at basically 4,200. It's too close to not use it, right? It's close enough to 4,200. The expectation is that when we get to an untouched point of control, there's very likely going to be a reaction in the market. Not strong stability. It's not a handrail to lean on. I wouldn't necessarily try to long off of that unless it's a first touch play, maybe a scalp trade, counter trend. Nice little contrarian setup. We've been seeing a significant move in the dollar. From 106.5 to 108. Doesn't seem to be slowing down any at all. And these pullbacks in the dollar have been pretty much the only shining light. Right? If we were to line up where the S&P made a little bit of a rally yesterday, it lines up with that dollar fading. Even in the afternoon, same thing again. A nice little move in the S&P matches up really nice with the pullback in the dollar. And that's just a nice visual representation to make clear, as long as the dollar continues to advance and strongly like it is, the more that we're going to see pressure against the S&P and the NASDAQ to go down. Right? So it's one of the reasons that we watch the dollar. The dollar is it's like any other indicator in RSI, MACD, stochastics. It's just another indicator. But it's why we watch it. An extreme move to the upside in the dollar is putting extreme pressure on the market, and the market goes down. Amazing how that works. Energy, on the other hand, has not been as impactful as it normally would be, very likely because of those petroleum reserve releases. We don't always have an answer for why something doesn't affect the rest of the market the way it's supposed to. We just kind of lump it into when and what should happen doesn't. We recognize that, okay, something right here. We're getting moves and we're not seeing the reaction that we're expected to see. Not much we can do with it, just recognize that it's not doing what it's supposed to do. The bullish rally argument was always predicated on the idea that the dollar was going to fade down, stay down, and get below that 105 level. And we had that nice sell-off in the dollar. Things obviously are changing around. Another thing to really kind of keep your eye on is the yield curve is still all out of whack between the 210. All right, in purple is the S&P. There's your June 13 or June 16 low. We began rallying out. Everything changed on July 15. It's when all the breadth indicators and everything thing just flipped on like a mad demon. The flow come into the market, and we just started ripping like crazy. Everything lit up. Look where we peaked in the dollar. So this whole rally up has been accompanied by a dollar fading off of those highs. Now we're starting to get a change in sentiment across the board. So watch the dollar, right? It's simple enough. Watch the dollar. The NASDAQ is down 1%. The ES is down 0.8%. All right, so the NASDAQ's down a little bit more. There's a little bit of an expectation that tech is going to get whacked in this move down a little more than, say, financials. So if we look at what's down this morning, Bitcoin's down the most. Semiconductors, 1.25. Communications, emerging markets. We use emerging markets for global risk on, risk off sentiment. Tech. Still not seeing finance in there. We have to go a long ways down, I suppose. Let's just try to throw it in there. All right, regional banks down 0.25%, much less than tech. Now, the XLF, on the other hand, is down nearly 1%, and it probably has a lot to do with the flows this morning, right? If we were to jump over and look at the XLF, it probably has more trading activity than the KRE does. So on the other side, what is doing good this morning? The dollar, the VIX. You're going to want to watch the sectors today, see if we can start that capital rotation. Utilities, industrials, healthcare, staples, and commodities, precious metals, maybe the pot stocks still, because there was that squeeze going on in beaten down names. See if that squeeze has any juice left into it at all. But if you're looking for something to go long in, and it's a day where the market is down, then commodities, precious metals, alternative products, right? Things other than whatever is going to have a beta to the S&P. Now, things with a strong relative strength: industrials, staples, oil and gas, energy. The financials were doing good. See the 210 still pretty crazy, pretty extreme. We are trying to come up off of an extreme low, but if you match where the zero line is, we're a long ways below the zero line. So the ones that are down the most this morning look a lot like the ones that have been doing uh, the best on this rally up since July. Right, like PayPal was one of those names that was significantly beaten down, and the rally off of the lows was pretty darn amazing. It's down over 2% this morning. Facebook's down 2%. Get into something like Nvidia. The rally off the lows in Nvidia wasn't as bad, but this wasn't as beat down as Facebook and PayPal. I would be targeting things like Apple. Apple made just an ungodly run, right, since mid-June. It kind of jumped the shark before everybody else. That move has been pretty significant. Should be able to get at least a 1 day, 2 day play, right? At the very least. I would still be looking for a reversal on this low today, only to the point that we come back inside of yesterday's price action. So we're not talking about running this market back down to the lows. We're talking about a 1 day trade, maybe 2. Preferably anything that made really big moves yesterday to the upside. Look for that countersink today. That'd be the best flip, right? And we don't have the big plays that we used to have when we could target Amazon and Google, since they've split, and now they're in a more normal, reasonable price. But for a 0 day today, everything is on the table. Google, Amazon, Tesla, they're all on board, right? Because it's Friday. So anything that you can find where you can put a 0 day credit spread on, say above the previous day's high, Right? If you think about it, say we'll use Google here. Google's going to open this morning down significantly from where we closed the night before. Once we get into the open, if you can price a credit spread at the high of the previous day, that'd be a good one, right? If that's too far out and your prices just are really horrible, then the close of the previous day, right? So instead of the high of the day, put your spread around the close of the day. You're basically putting on an argument that says, I don't think Google can rally back up once the bell rings, get through its own open from the previous day, and get above the close of the previous day. That would be the argument. Say in AVGO, this kind of fits the bill of what I'm talking about. AVGO had a massive day yesterday. Beautiful run. Broke through a lot of pivot points on its run up. Couldn't keep the breakout. Kind of faded back a little bit. Now it's going to, at the moment, open pretty much 50%. If we can get that down a little bit more, a little more weakness, the target would be to put a credit spread on around that 560, maybe the 555 area. And the the argument is that with all the weakness today and going into Friday and OPEX and everything else, that this just won't have the gusto or the strength to make another really big sweeping day 2 days in a row. Right? Like if it burned all of its fuel yesterday, putting a cap on that thing for a 0 day today, be a pretty good bet. Baidu's up in the pre-market. Applied Materials and Activision slightly, barely. If we are going to get that rotation, look for things like Pepsi, Coke, Walmart, Costco, Walgreens, right? Look for that kind of rotation out of the sexy, glamorous tech again and back into the more boring, staple, those kind of products. General Motors is up. Home Depot slightly. Now on that credit spread discussion, one of the things you might want to make sure, if you want to have a little more, I don't want to use the word safe, but if you want a little more edge in your trade, try to find things that have a completely broke outside of yesterday's price action already to the downside, like the ES has, right? When we were looking at the ES and it's already outside of yesterday's price action, or Apple, for an example, is already outside of its own price action. Because then the benchmark would be, well, first Apple would have to get bullish, break back inside of its low, get past the close, get past the open, get past the high, and then get you with your credit spread sitting up at 175. Right? That's kind of the logic behind it, right? All those pivot points would be there to assist you and help protect you from getting ran over by Apple. Now, make no mistake about it, if we just turn around and the flows come in, price can do whatever it wants. It can easily make that move. We've seen Apple make, significant moves in a single day. It also has a market maker move right now of 0.71. Right. So when we take and put that in with the rest of the argument, Apple can make the run back up. It's not to say that this 0-day idea is something they can't lose. So target things that already made a big move, like AVG, and also has already fallen completely outside of the previous day's price action. That would be a combination of events, right? It burned all of its energy yesterday and it fell below yesterday's price action in the pre-market today. Then put your credit spread on the top of that. You could also look for the reversal. So if we do start to rally up, a credit spread on the lows of the day today, running it back up into the evening to get out, right? It is my day to stream, but I've got an appointment to get to this morning, so I will not be live in the Bullish Bears today. I have to meet with college counselors. I'm going to be going back and getting my doctorate. And I could not get it scheduled for any other time, so it's got to be during my live stream this morning. So I won't have a live stream this morning. Everybody be careful, be safe, and I will see you all next week.